Hey everyone, welcome to this explainer. Today we're diving into a genuinely fascinating and honestly highly critical analysis originally put together by the financial channel Casual Finance. We're looking under the hood of the upcoming massive SpaceX initial public offering. And let me tell you, this analysis really challenges the standard narrative. It digs deep into the numbers, the actual structure of the company, and some very quiet behind-the-scenes rule changes in the financial markets. So whether you follow aerospace, finance, or honestly just have a standard retirement account sitting around, you're going to want to hear this.
Right. To really wrap our heads around the scale of this whole thing, we got to start with the target valuation. Elon Musk is currently prepping what is set to be the largest initial public offering in human history. The target? A staggering $1.75 trillion. That's trillion with a T. It's a number so astronomically large, it kind of defies all standard market logic for a newly listed public company.
To put that $1.75 trillion into perspective, at that valuation, SpaceX would literally be worth more than every single American defense contractor combined. Think about that. Actually, scratch that. Let's take it a step further. If you took the total market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks and put them all together on a scale, this single IPO is aiming to outweigh the whole shebang. It would even blow past the top 10 companies on the London Stock Exchange combined.
Which naturally brings up a seemingly impossible question. Who exactly is buying a company at this historic record-breaking valuation when, as a consolidated entity, it's reportedly losing billions of dollars a year? Well, to answer that, the analysis suggests we need to look past the shiny rockets and really understand the actual structural reality of the company.
Section 1. Inside the SpaceX stack, more than just rockets.
Okay, so to make sense of a nearly $2 trillion price tag, we have to recognize that SpaceX isn't just one big unified business. The analysis beautifully breaks the company down into three distinct, nested businesses. First up, you have xAI, the artificial intelligence lab. Then you've got the traditional rocket business that launches cargo. And finally, Starlink, the satellite internet provider. Basically, you can look at these as the cash burner, the traditional public-facing business, and the crown jewel.
Let's look at the financial reality of xAI for a second. Just a few months ago, SpaceX acquired xAI in an all-stock deal that accounted for $250 billion of that valuation. But let's compare that to some industry heavyweights. OpenAI generates around $24 billion in annual revenue at an $850 billion valuation. Anthropic generates over $30 billion annually at a $400 billion valuation. Meanwhile, xAI, it's estimated to bring in just $1 billion in revenue, yet it was bought for $250 billion. So the market is pricing it like this premium, fully established asset, but the underlying numbers tell a vastly different story.
And it gets even more complicated. You see, xAI was originally founded with this incredible, heavyweight team of 11 co-founders from places like DeepMind, Google, and OpenAI. Sounds great, right? Well, by March of this year, every single one of those 11 co-founders had walked out the door. Elon Musk himself publicly admitted that xAI essentially had to be rebuilt from the foundations up. So effectively, SpaceX paid $250 billion for an asset that literally needs to be reconstructed from scratch, all while burning roughly $1 billion a month in the process.
So if the AI division is a massive cost center, what's actually driving the revenue? Well, the famous rocket business, launching things for NASA and the US government, generated roughly $4 billion last year. But get this, that only represented about a quarter of SpaceX's total revenue. The real financial engine here is Starlink. It accounts for a massive 61% of total revenue, bringing in an estimated $11.4 billion.
Make no mistake, there's legitimate, incredible value inside this company, and it's primarily driven by Starlink. I mean, with over 10,000 satellites in orbit, it's the fastest scaling telecom company in history. They've got over 10 million active subscribers across 150 countries. Entrepreneur Scott Galloway even called it the best product of the last few years. And the financials absolutely back up that hype. Starlink's profit margins have expanded from 41% to 63% in just 2 years. It's basically a cash-printing machine.
Section 2. The profit illusion. The reverse Jerome Powell.
But here's exactly where those three distinct units violently collide on the consolidated balance sheet. Remember how successful Starlink and the rocket business are? Combined, they pulled in roughly $8 billion in profits. But xAI acts as what the analysis brilliantly calls a reverse Jerome Powell. Instead of printing cash, it just burns whatever cash the rest of the business generates.
Because of that massive AI cash burn, the consolidated SpaceX company actually ended up losing nearly $5 billion last year, despite pulling in roughly $18.5 billion in total revenue.
Section 3. Rigging the NASDAQ rules, rolling out the red carpet.
Now this brings us right back to our original hook. How on earth does a company losing $5 billion a year go public at a record high $1.75 trillion valuation? And more importantly, who's footing the bill? The analysis points directly to a series of recent, very quiet rule changes adopted by the NASDAQ this past May. Under the old rules, a newly listed company had to wait at least 3 months to be added to the NASDAQ 100 index, giving the market actual time to discover the price. They also needed at least 10% of their shares available to the public. But the new rules? Incredibly, they compress that waiting period to a mere 15 trading days and completely eliminate the minimum free float requirement.
Let's break down these 3 distinct rule changes step by step because they essentially completely bypass traditional market safeguards. First, the fast entry rule speeds up the timeline to just 15 days. That means SpaceX gets dropped right into the index and secures automatic demand almost immediately. Second, removing the free float minimum allows SpaceX to qualify with just a 4 to 5% free float, something that absolutely would have disqualified them under the old rules. And third, there's the hidden multiplier.
The real trapdoor in these new regulations is buried deep in the technical language. There is a hidden multiplier, a rule stating that for companies with a free float under 20%, the NASDAQ will treat that float as if it were 3 times bigger than it actually is. Think about what that means. SpaceX's tiny 5% float gets legally weighted for index funds as if it were 15%. This legally requires ETFs to buy 3 times as much stock, essentially building massive manufactured demand out of thin air.
Section 4. Your 401k is exit liquidity, the mechanics of passive investing.
So how does all this manufactured demand actually get filled? Well, it connects directly back to you and your everyday retirement accounts. To highlight this, the analysis impartially reports a totally on-the-record statement from SpaceX CFO Brett Johnson. While most IPOs allocate maybe 5 to 10% of their offering to retail investors, SpaceX is targeting an unprecedented 30%. Johnson told bankers this was to recognize retail buyers who've been incredibly supportive of the company. Translated, this means the largest IPO in history is preparing to dump nearly a third of its supply directly onto retail investors, essentially banking on brand loyalty.
The crucial takeaway here is summarized perfectly by portfolio manager George Noble, who said quite bluntly, your 401k is the exit liquidity. The grim reality laid out in this analysis is that the buyers and sellers don't show up to the party at the same time. Insiders are sitting on low-cost shares that unlock much later. Meanwhile, thanks to those fast entry rules and manufactured demand, passive funds and retail buyers are forced to absorb the stock early, right at its absolute peak valuation.
You know, it's really important to remember how passive investing was originally sold to us. It was championed for its low fees, easy diversification, and the whole set-it-and-forget-it appeal. And all of that is true. But the analysis points out a major hidden catch. The automatic nature of these funds means you are investing without input. That exact same mechanism makes your 401k a guaranteed, unconsenting buyer for absolutely any company that manages to squeeze its way into the index.
SpaceX just happens to be the first in line to utilize these newly tailored rules, but they almost certainly won't be the last. If the system can be adjusted to automatically funnel retirement capital into an unprofitable company at a record-breaking valuation, we really have to ask, what else is quietly hiding in your index funds? Thanks for joining me for this explainer, and keep asking the hard questions.